welcome to Trading Group 2 for Capital Discussions. Today's Tuesday, March 22nd. So Andrew and I were just talking about the terrorist attacks in Brussels, and we went on base, and they had two guys standing in front of the door checking IDs to get into the hospital. So yeah, the military stepped up the security in the local area too.
Yeah, I don't know if today's lower opening in stocks had anything to do with it, but they certainly don't seem concerned right now. They rallied back to unchanged.
Here, there we go. Thanks, Brian. Okay, people are still coming in here. So, did anybody make any moves on that down move this morning?
It didn't stay down there very long. You did not have much time. Unfortunately, it's usually tough to get decent pricing right on the opening, and the market just bounced pretty quickly. So, I would imagine it would have been tough to take advantage of the lower prices.
Yeah. So, Andrew, how are your trades doing in general?
I'm still in my bearish butterfly. I'm kind of, hanging in there. It's down about 20%, and I keep waiting for this market to get tired and roll over. I haven't done any adjustments in a while, other than I rolled in some of the lower long puts just to raise the T+0 line inside the tent in case the market comes off. And at this point, I'm just trying to hang in there with the trade long enough for the market to have some kind of meaningful correction.
You mind sharing it so we can get a visual?
Yeah. I mean,
there we go.
This is this is the position. I think it's pretty much what I've had for a while. The only thing I did was I rolled the 990 puts up to 1010, just to give me a little more on the downside. That's where I'm sitting right now. It's down, just around 20% right now. Max loss is $7,500, and this is what it looks like right now. So if we get any kind of pullback, hopefully we'll be able to make some money on this thing. If the market continues up, I think what I might do at this point is maybe roll the upper butterfly higher and try to stretch out the tent. I don't think I want to get into the final third. I think I want to stay at 2/3 in the position, and butterfly up. Then I'm locking in a pretty big loss. I'll knock the T+0 line back down to 0 again, and I'll have to wait for it to come up. Whereas if I roll the upper butterfly up, I'll stretch out the position and hopefully give myself a little more time. One of the good things is that, the P&L is finally matching the T+0 line. For quite a while, the P&L was below the option view, T+0 line. So now it's just about caught up.
So how much farther would it go on the upside?
Well, to hit max loss, I've got probably 15 to 20 points, which is very possible. The reason I'm hanging in with this position is just because the market is just so overdone.
Pretty strong.
Yeah,
We get
I
more.
saw somebody just asked a question, but I didn't see.
Oh, Tom Hoffman asked, why is the broken butterfly asymmetric?
Oh, what? Okay, yeah, I don't know. I just mentioned that before. The reason I did that was I rolled in the 990 puts to 1010. I can I'll show you what it looks like. I mean, that's classic bearish butterfly 2/3 entered, and you know, that's what the position is now. As you can see, it creates almost no added risk on the upside, and yet it dramatically improves the downside, which is why I did it. And you know, it did cost a little bit of money, but it just improves the downside so much. It seemed worth it. You know, without adding barely any upside risk. You know, my response now would probably be if we go up to move this 1060 butterfly up to 1080 to try to stretch out the position. And the way I would do that would be two orders. One would be a put condor. Would be this put condor and then also a butterfly. And that would make this minus 10 and this 10 and this minus 5. So, oh, I goofed somewhere. Where did I goof? Minus 5 at 1080 plus 10 at 1060 minus 5.
The 1080 need to be negative.
Oh, this needs to be negative, right? Yeah, that's that option view. That bug in option view. Okay. Now we would just stretch the tent a little bit. It would, bring me a little closer on max loss, but it would stretch the tent a little bit. So I'm kind of undecided about, whether I do that or not.
Andrew, I have a question regarding your this particular trade here. Is there a reason why you don't have a 3/3 right now?
Yeah, the reason I don't have the 3/3 is that it's part of my my trade plan to extend the range of the trade. By staying only in 2/3 rather than 3/3, you give yourself more room on the upside. And I also changed the add points and the roll points a little bit. If I had followed the guidelines, I would be in 3/3 and probably have hit max loss already. So by staying at 2/3 and by delaying the rolls and staying behind the market, I've been able to stay in the trade and keep it alive longer.
Thank you.
Hey, Andrew, this is Steven. You may,
Hey.
I don't know what your timing is for possibly rolling the upper fly to extend your tent, but your Vega is getting a little borderline now.
Yeah, with the bearish butterfly though, to be honest, I'm not really concerned.
Yeah.
With Vega. What I am starting to get close to is maximum delta, which is 250 for the position.
Did you see Dirk's question about delta theta guidelines?
Well, yeah, I mean, delta theta is not a problem. I know I'm way over, but because I'm not following the guidelines, I'm not as concerned with delta theta. If this was a normal trade and the market wasn't up so much, I'd be a little more concerned, but I just don't want to roll on top of the market. I know if I was following, delta theta, I'd have been rolled up on top of the market. But I'm just concerned about rolling on top of a market that's up so much at this point. If as I said, if I was following the guidelines, I think by now I would have been fully entered and out at max loss. So by doing what I'm doing, I'm just buying myself a little more time. The way the market's acting, honestly, I think there's a pretty good chance it's going to hit max loss. But as I said, with the market up as much as it is, I'm just trying to give myself as much time to hopefully catch some kind of pullback. The other thing that I'm looking at is by the end of the week we'll be down to 21 days, and if I have to roll this position, because of delta, I think I might roll into May rather than into April. If I have to roll out of that lower butterfly and roll into the 1080 position, I probably roll into May and try to keep the trade alive because we're closing in on May entry anyway.
The thing to be aware of, Andrew, I think, is that we definitely have had a time reset now. So on RUT, you've now got about a 40% time reset, which is beyond John's 30% rule. So that could be something else to keep in mind too.
Yeah, which is another reason I think maybe to roll into May. If it's either that or just pull the plug on the trade. But if I want to continue the trade, I think I'd probably want to go into May. Just because there's so much less problems further out in time.
Do you see Vishal's question? Is there anything specific that makes you think the market will go down?
Right now, there's nothing specific that makes me think the market wants to go down. The only thing I've been looking at is on the daily chart, we're back into that trading range in the SPX, which could end up as a zone of resistance. There's this is a pretty sharp channel up, and we're due for some kind of pullback. Even if we get some kind of pullback like we had here in the SPX, hopefully we'll get something in the RUT too. The RUT is up against this resistance area at 1110. You know, have a low here, a low here. You have this area here where the market accelerated down. So right now, it's possible this little breakout here could end up being a failed breakout. We'll have to see. If it's not a failed breakout, then you know the trade is probably going to hit max loss. If it does turn out to be a failed breakout, then you know we could come back down to here. You know, if you notice, the rut has started to lag again. On the days where the market's weak, the rut is noticeably weaker. And you know, on the days where the SPX is strong, the rut usually lags, although every once in a while it leads. But there's definitely been a divergence there between the small caps and the large caps, which may be another sign that the market wants to take a breather. I mean, you know, if this area is a reset area, then yeah, you know, we could shoot up quite a bit higher. In which case, you know, the trade's a max loss, and we'll just have to close it. And if that's the case, then I would not get into another bearish butterfly, because as Ron said, there's a chance of another big move up.
Yep, especially on RUT. RUT is not as overcooked as SPX. I think SPX has a greater likelihood of having some minor pullback, but RUT looks like it's just reloaded.
Yeah, it's what makes you know analyzing this market so tough right now is that that divergence between the markets. I think you know, if the RUT does break higher, then I'll probably go into an M3 for May.
Andrew, I'm sorry if I'm asking something that you already explained. What was your entry point for this particular trade? How long have you been chasing this one?
I entered the trade when the RUT was at 1020. I entered at 1,000. So I entered at 1,000, and then I rolled up to 1020, and then entered the second at 1040, and then rolled from 1020 to 1060, and that's where I am now.
Thank you.
I mean, to be honest, I was counting on, you know, this resistance level here holding, you know, along with a lot of other people. If this area here is the whole pullback, you know, from this rally up, then we're in trouble. The RUT could go a lot higher.
I see Dan Harvey's here. Welcome, Dan. Dan, I had a question. I know on the road trip trade, if the market runs up, you generally just let it go. But have you done anything with this strong market differently than you normally do? I don't know if Dan's able to call in or not. Maybe not. Oh,
This
he
is
says.
call in.
Yeah.
I haven't looked at it in a little while, but I'm going to guess at this point that the road trip trade is probably so expensive that you might not even want to enter it.
Geez. paste it in the info. And Dan, if you go on the event info tab, it should have all that information too. Quick Start tab also has it on the plan. I know Adam Grimes, he's saying that the market's pretty strong and any pullback is a buying opportunity.
That's
Morning, Tom.
That's certainly been the case so far. Every lower opening we've had has been a buying opportunity.
Yep. Hey Dan, I see you're on.
Yeah, I'm on. Can you hear me all right?
Yeah, fine.
Okay, good morning, everybody. What was the question? I've already forgotten.
Just
Something about the road trip.
It's been really strong lately, and the road trip trades obviously don't have much risk on the upside. So have you done anything with this really strong market differently than you normally do on your road trips?
Well, what I have found, I went through a period of about a month wherein I tried some fancy maneuvers, such as adding condors, and I found that to be fairly unsatisfactory. In fact, completely unsatisfactory, because we have had a strong move. So my call side got the hit, of course, and so I had to cover that. And the long story short, what I have determined with some additional backtesting is the way that I like to approach this, which again is not for everybody, is to simply leave the thing alone, as much as I possibly can, and then on the upside, when the current market is 40 or 50 more greater than the upper long put, I will start to bring in the wings, and I'll just be looking to get out at a credit. At a positive. In fact, letting it expire, hopefully. And what I've determined is, for me, for my style of trading, namely not wanting to do too much and being basically lazy and being gone and things like that, I would rather get a positive expected return by doing multiple cycles, and when we are in an extended rally like we are now, just being willing to take between $500 and $800 of profit, and and occasionally getting up $2,000 of profit, but doing this every week, and you still get positive cash flow with not a lot of manipulation and no upside risk. So that's the way that I've been approaching that. So on several of mine, I have brought in the upper wing to the point where I'm just going to let the thing expire at a profit, as I said, between $500 and $800. On the most recent ones that I have put on, they're still looking okay. And of course, if we have a little downward move, then I'll be back into the 10 to 15% profit zone. So that is my approach. And I see there's a question here from Ralph. Yeah, hi, Ralph. Yes, I like to split the upper strikes. What I try to do, well, I can show you my most recent one if you want me to, Tom.
Oh, sure.
Okay, let's see. Share my screen. Okay. So, yeah, so for example, Let me just get a couple of my most recent ones here. This is the May week 1, and this is still okay. And so you can see I have split these, the upper puts, and so the most that I can lose, if we're above the tent, the most I could lose, if I were going to let it expire, which I wouldn't, would be $247. And this sort of makes me think, I was watching some other program wherein a back test was done. I'm not going to mention any names or any software, but you're all probably familiar with it, that basically said, sure, if you pay $3.50 for the butter, that's no problem. Well, actually, that is a problem because if you have an extended rally like we're having now, and I think everybody that has any style butterfly on is now facing this, you have a major problem with an extended upside rally, and if you have paid a lot for the butters, you're basically fighting a headwind. You're trying to walk forward, in a hurricane, and it's really tough. And so if you can get it as cheaply as possible, that's the way to do it. And one of the easiest ways is to split the upper strikes. So I try to launch the trades using a ratio of these longs such that I have the expiration line really close to 0. And so what I would plan to do would be, to carry this thing forward here. And here we are at 35 days. And if we dropped off a little bit, I just would take that money, which would be $690. If we dropped off a lot, I would take more money. So that's the way I'm approaching this now. And I have
Dan, this is Tom Henley. You have time for a quick question on that one?
Yeah. Okay. Yeah. Sure.
Okay. Looking right now, the peak of the tent is well beyond one standard deviation, and if we look at say 1920, 1915ish, looks like it might be about 1.5 standard deviations away. Would you consider possibly using a put credit spread, basically telling the market, come get me, get to the peak of the tent and beyond before I'm in trouble?
Yes, and I have done that, and that actually works out quite well. Where I got into trouble on one of my March trades, which is now gone, is that I sold condors. Well, the call side of the condor got hit. But yes, if you are willing to increase the margin, which is not a problem since this is only chewing up 11.7. Because I make these relatively small trades because I have one about every week, so they're relatively small trades. So I wouldn't mind increasing the margin and selling it out of the money. Put credit spread works pretty well. You could probably, sell a 10 or 15 delta, put credit spread, and you'd be just fine. So yes,
okay,
that is a good idea.
Just trying to milk it for an extra few dollars. That's
right, and that actually
it's
works
a simple
great.
trade. It's a good trade.
What I would not recommend is selling a condor.
Okay. Thank you. I appreciate
that.
Because
you may not think, you may not think the call side would ever be hit, and but I'll be darned if it wasn't hit. And
Murphy was an optimist. But
yeah, this market has tremendous legs, as they say, and if you look at any of the futures charts or anything, it's just very impressive. And so I have, I'm a firm believer in John Carter's thing with the weekly squeeze and the weekly wave C above zero, if people are familiar with that, you just don't want to fight that. And so I wouldn't recommend selling a condor, but I would agree when you get this far from the tent, sure, bring in a couple more bucks. And I'll just finish up. I'll show my other recent one here. So this is the May 3, the regular monthly, and so this one has a lot of room to germinate here. And again, low margin, but once again, if we continue way up here, I wouldn't lose much even if the thing expired, $200. But I would try, if we got up here, I would be looking to take a small profit and just, be out of it. And the idea is that if you have, a little bit coming in every week, sometimes not so much, but every now and again, a 10 or 15% return, you're going to have a good expectancy over time. So that is my thinking.
Thank you for your thoughts, Dan. I appreciate that.
Oh, you bet. So, this is a very simple trade, which of course is what I like about it. And I know a lot of people in the community like the M3, and I think it's an excellent trade. I just at my stage in trading, I'm just looking for the ultimate in simplicity, and to not have to stare at the screen all day and to not have to fight something all day. So that's why I like this trade. Now, somebody said, and I would agree, with the rising market, these butters are a little more expensive, and indeed they are, but they can still be done, up to a point. You might have to maybe go a little bit farther out in time, for example, to be able to generate a decent return from them. So that was all I had.
It's a simple trade. Yeah, it's a simple trade, Dan, and yet there's ample opportunity to, play around. If you like to make things more complicated, as you just demonstrated before. So it's a great newbie trade, but it's also a great trade for experienced people who know how to augment it with various techniques.
Well, that's actually true. I mean, you can superimpose a variety of things, credit spreads. You can superimpose a calendar if you want to, which will hedge it off a little bit and might even make you a little bit. You can move the strikes around because obviously, like nearly all options trades, is just verticals, and you can move them around. The strategy actually will allow quite a bit of flexibility for people who do want to futz with it. My futzing days are over, I think. I try to keep things as simple as possible. But certainly, I think everybody would agree there's usually a lot less futzing with this than there would be with the M3. And certainly with some of the other butterfly configurations. And this is definitely not the market for a weirdor, I don't think. It's a pretty tough market for a weirdor, if you have a call side. Now, if you want to do a weirdor in the sense of only having put credit spreads that are hedged with a debit spread, if you sell one of those on a down day, and then you're willing to take it off in a hurry when you rally back and take your money, those work well now. But weirdors work the best when we've had a down period of 2 or 3, pretty good down days. That's the time that I like to do weirdors because, reversion to the mean, we're likely to rally back and sometimes you can get your money out of those in just a week or two.
I think at this point, volatility has gotten down to the level where you're going to have problems generating credits on a condor without taking a lot of risk.
Yes, that's exactly right. You'd have to move your shorts in closer to the money, and then, of course, when you do get hammered, it's going to hurt unless you get out in a hurry. Yeah, I would agree.
Hey, Dan, quick question.
Sure.
Since we are in a low vol environment, when did you put this trade on? How many days to expiration? And how much more are you willing to pay for this spread?
Okay, the one that I'm showing right now, I think I put on last week. I think I'm still in the try to get these at 65 to 70 days out. I've been looking to put on the May 4, but I haven't had an opportunity. I thought I was going to have it today at a reasonable price. I had it set up, but it didn't fill. And well, let me see if I have this still sitting here. Yes, I do. So let me put this up to analyze here, and put this one up to analyze. Okay, and take those out and put these in and unlock everything. So you see this, I would have set up as a little ratio thing, 4 of one and 5 of the others. And this is, see, I'd still wind up, paying $1.50. And I'm trying to get in at around $1.30 net. And what I use is rather than the actual calculation, I'm looking at the expiration line. And I don't know if you can see my screen. Let me make this a little bigger here. You can see the expiration line would be a negative 545. So that's too much. I like to get the expiration line to negative $200 or even less. Certainly negative 250, I should say, or less. So this is not going to fill, and I don't actually want it to fill at these prices. So I don't know if that answers your question.
Mm-hmm.
Now you could, manipulate this. I had this order in earlier this morning when we were sitting about here. So I could, redo the whole thing and, set that up, but I'm not really going to do that because with the market having rallied back a little bit after we gapped down, which, well, actually we filled the gap very nicely in most markets, so that would have been a good play, but I missed it. Anyway, that's another story. I don't think I'm going to get a fill on this, so I'll just look again tomorrow because I do not like to put these on an up day for 2 reasons. Number one, the prices are bad; they're too expensive, and number 2, if you put them on an up day and then you have 2 or 3, hard down days, well, you're already in the middle of the tent. So I like to put them on a down day, or even better on the second or third down day, and that way I'm going to be reasonably assured that I will make some money from the trade. It may not be in the tent, but I will make some money from it.
Yeah. So what prices would you, right now, what prices, I can't see the prices you're working. What prices would you take on the 4 lot and the 5 lot together?
Okay. Let me go back. The prices I'm working.
I see. Yeah.
Yeah. But that's not going to fill unless we move on back down, which I don't think we are, because we're still there are the Dow futures, and so as you can see, we came out of a little one dot squeeze here. This is a 144 tick chart. We came out of a little one dot squeeze, and we've been up ever since.
Right.
And we have a very strong C wave. I would imagine most people in the community are pretty familiar with John Carter's squeeze stuff here.
Yeah.
But, everything is strong. The MACD is strong. We're well above all my moving averages, so I don't know. I mean, obviously, later on in the day we could fall back, but I really don't expect to get this.
Right. One final question. I've noticed in your examples, even on your order page, that you are in the SPX and away from the rut. Is that by design, or you just seem to see a little bit more liquidity in SPX with regards to setting these particular trades up?
For this particular trade strategy, I'm seeing a little more liquidity and a little more money. The fills would be about the same. I've looked at this road trip with the rut, and obviously it will work. But I've had better results with the SPX. Now for the Weirdor, I like the rut, and for credit spreads and condors, I like the rut. But for this particular trade, I've had better results and better fills with the SPX.
Mm-hmm. Yeah. Great job. Thank you for your time.
Oh, sure. You bet.
Hey, Dan, I have a quick question. Regarding these particular entries that you have in here, how often do you get filled on both of them at the same time, or how often do you have to chase one after you get filled the other?
Yeah, that's a good question. What I do when I put these in, I try to get a little better than the mid price on each side by a nickel. And they are not both going to fill. One of them will fill, and then I will have to work the other one, and hopefully I can get it at the mid or maybe just a nickel off the mid, and then I'm in at a pretty good price. So I just let the order sit because sometimes they'll fill, and when one of them fills, I will work the other one. And the other thing that I do sometimes, depending on market movement during the day, if I really want to get a fill, I will adjust the ratio. I'll take fewer of one and more of the other. It just sort of depends on market movement. But for this particular order, since as I say, it doesn't look as if we're going to come down much. I mean, we were pretty strongly negative earlier this morning, and now we're back in the green again. So I don't really know if we're going to come back. The ticks are still strong. The breadth was negative. Now it's turning positive. So I don't really expect we're going to drop today, so I don't think I'll get a fill.
It's a shame you can't work a four-legged order with Thinkorswim.
Yeah, that's right. I think some platforms. I'm not sure.
Yeah,
which
IB.
one,
you can do it in Interactive Brokers. You can work a four-legged spread.
You can do it in IB. Yes.
Dan, have you tried the concept, instead of doing the split like you're doing now, where you're doing roughly half and half, doing like the full lot with the standard 40-50 broken wing, and then basically adjusting with a vertical, which I'm assuming is probably going to be easier to fill?
No, I haven't. That's actually a pretty good idea. I haven't tried that. How would you do that?
So I'm just thinking, because if you were like with this split that you've got here, you've got a debit of $1.45, and then the other one that's giving you the credit. So that's giving, in combination, is going to give you the overall starting debit that you're actually looking for. But I guess the only thing that I'm thinking of is what could happen is that you get filled on the one that you're paying for the debit for, and then when you then want to go chase the credit one, then you then don't get the credit that you actually want, because it's tougher to fill a broken wing than it would be a vertical, right? So if you were to put in the price that you want and think is reasonable for the standard 40/50, being aware still of what you're going to get for the vertical, right, for basically rolling back the upper long by 5 points.
Oh, I see.
Or whatever you want.
Yes.
Right. So then when you get filled on the full lot, you simply adjust with a small vertical, and that vertical should fill much more easily than a broken wing.
I think that is actually an excellent idea. I wish I had thought of it, but I haven't been doing it that way. And the reason I haven't been doing it that way is because I set up the ratios such that, like I said, on the risk graph, that I get, whatever, 250 or left on the expiration line. But obviously, the way you're describing would work just as well and better because, as you indicated, there would be a greater likelihood of a fill. So I think that's a great idea.
Okay.
It would just be working a butterfly and a credit spread.
Yeah.
Right, exactly. And the credit spread is much more likely to fill.
Right. And is that how you're starting the trade-off now, in terms of price being roughly about 10 points above your upper long?
No. I had this trade on when we were sitting about here, so I'm roughly 5 points above the long. I don't think it has to be that exact. I don't like to start these sitting inside the tent because I think you're asking for trouble. But the reason I'm so far above is because we have come from there to there.
Okay.
Hey, Dan, did you see John's question about the thoughts about going out a little farther, like 80, 85 days to get better prices?
No, I didn't. Let's see here. What was the question exactly? Because it's probably buried back here someplace.
It's the third from the bottom. It says, if you're putting on a new road trip about every week, do you... Oh, wait. One above that, sorry. How about going out 80 to 85 days expiration to get better prices on trade entry?
Yeah, certainly you can do that. I generally don't go above 75, but there is no magic number. And since my approach is to put one on just about every week, it really doesn't matter. You get the better prices, and so yeah, certainly you can do that. And in fact, I may wind up doing that to get, instead of the May 4, I may have to go to the April 1.
Dan, I just want to continue on the comment from Ron. Sometimes when you are so far out of the money, those strike prices of on the fives, like you have here at 2035, are going to be harder to fill because of the lower open interest on that. So just continuing on Ron's observation, maybe that credit spread that you want to sell, instead of being the 2040, 2035, can be at 2040, 2030. And in that respect, you won't need to have the same number. You will have to see how many contracts you need to sell on that credit as well to get a better feel. And I don't know exactly how it will work, but I have observed that the spreads of tens are easier to fill so far out DTEs on the tens and the fives in general.
Yeah.
Does it make sense?
You're right, and it is easier to fill. You're right about that. But sometimes, you have to look at the option matrix, and sometimes there will be a reasonable amount of open interest, and even some volume, and they will fill. But as you indicated, I don't think this one's going to fill, and I certainly don't. I don't think I want this to fill, so I will probably just cancel this order unless we drop off today. later on in the day because I don't think I want this one to fill. But you're right. Just like on any option, a trade of any kind, you have to look at the volume and open interest. Plus, you have to look at the bid-ask spread to give you an idea of the degree of liquidity and the likelihood of a fill. But that's a very good point. Thank you.
And Dan, Ralph had a question about after splitting the longs, at what point on a down move would you reset the longs to compensate for the move?
See, where's this question?
It's at the very bottom.
Oh, okay. Okay, would you reset the longs to compensate for I assume, an up move, right?
I think he's talking about a down move.
So basically the question then is what happens when we move through the tent and start heading this way, right?
Yep.
Okay, that's a good question, of course, and that is the side with the risk. And I'm going to have to sort of give a fudge answer, and the reason is because that depends on the individual trader's tolerance for risk and the desire to try to work the trade to stay in the trade. And so what do I mean by that? Well, certainly if the market were to move down in here 2 weeks from now, you'd be gravy. And let me get some day steps here. So if this thing were to fill, and we moved down here, you'd already be up $2,300. So you just would take your money and say thank you. But the problem arises is if only a couple weeks from now you're down here someplace and you're down $400 or $500. So then you have to decide as an individual trader based on your best estimate of what you think the market is going to do, namely, is it going to come back or is it going to keep on going down? And you have to make a decision whether you want to stay in the trade, leave the trade and leave it forever, or simply reposition the trade. So those are the three choices that I would see. So if you decide to stay in the trade, you can do all sorts of things. You can bring in the lower wing to raise this up. You can do a combo trade, buy a put and sell a call spread way out here someplace. You can you buy debit spreads. You can do a variety of things, which Tom summarized very nicely in the PowerPoint thing. So that's what you would do if you decide to stay in the trade. If you decide to exit the trade, you can simply take a small loss and you're done for that cycle, knowing that the strategy overall has a high win rate and you're likely to do well, but just not on this one. And then the third choice, which is one that I like, given the scenario that I just now outlined, you have lots of time left in the trade if only a week or two, have transpired since you launched it. So you can simply take it off and reposition it, and now you'll make back, or you'll have a very, very high probability of not only making back what you gave up, but making some money of, turning a net profit. So what I like to do is if we get in this situation where I am showing now, and I look at my P&L and I'm not down too much money, I will, do one adjustment and one adjustment only, which would probably be to buy a combo since the margin is not that much of a consideration. So I would increase the margin requirement of the trade by adding a combo. That's going to bring this up, and it'll buy me some time for what will hopefully be a reversion to the mean. But then if that fails, then I'm going to reposition it. So I hope that answered the question.
I think so. Well, thanks, Dan, for answering all those questions. You've shared quite a bit of information. Ron has something he wants to share, some research he's done on option decay across expirations. If you don't mind, we can switch over to that for a few minutes and go a few minutes past our normal hour.
Sure, absolutely.
Okay, so let me find Ron here. You're hiding, Ron. Oh, there you are. Okay, Ron, see your screen.
Great. Yeah, I just wanted to show a couple of some things that I was just working on last night as well, but which I thought was interesting. So we'll see if any of you options geeks like this too. So okay, so just to recap on one of the things that I covered in the space trip presentation, and that is, I think, a pretty important point, right? And that is that out of the money options decay faster than closer to the money options. Okay, and this is not some invention; it's based on absolute fact. So let me kind of just quickly kind of show that, and then I'll show you how this actually happens across expirations too, which is the new stuff that I found last night, which was quite interesting to me. So the first thing is just kind of looking at. So don't worry about all the data here, right, but I'll just kind of briefly touch on it. So this column here is showing the theta of a particular strike. And then this thing over here, I mean, we can actually just look at the mid-price is probably easiest. And so if you look at the mid-price or the extrinsic, right, because anything out of the money is basically 100% extrinsic anyway. But everybody knows that theta is basically the amount of daily decay that you're going to have within the option, and the extrinsic is the total amount of time premium, essentially, right? But total amount of time premium. Therefore, if you were to look at the ratio of this, which is your daily decay, compared through to the total decay of that particular option, that's going to give you a ratio, right? Basically, the percentage decay of that particular strike on a daily basis, right? So on a daily basis, the 1875 strike is losing 2.46% of its time value per day, okay? And then just by looking at this column, you can see that the further out, and this is at the money here, and as we go down, this gets away from the money, okay? This is out of the money stuff. So you can see here just by looking at the theta percent column that the further away from the money we get, the greater the percentage of the decay, right? So the decay rate decays faster for anything that's out of the money than it is closer to the money, okay? If you want to see that visually, that's this here, right? So if you look at the purple line, right? So, and at the money is towards the left, right? So as we go further away from the money, you can see that the decay rate gets steeper and steeper as you go out, okay? So that's that, and I kind of covered that in the space trip trade presentation. Now, if we then look at this, right, which was the extrinsic value, but now across expirations. Over here, what I'm doing is I'm basically looking at the June versus the May expiration. Okay, so this is roughly, I think, 87 days out now, the June. So then if you look at the height from the line through to the zero line is down here, right? So then if we look at something over here that's essentially close to the money, and you basically look at the distance from the cyan line all the way down through to zero, and then compare what happens after we go from June through to May, which means that time has expired or traversed, right? So on a percentage basis, it has decayed from here to here as a ratio of the entire distance to here, right? So, you know, just eyeballing this is, I don't know, like maybe 10% or something, right? So from here down to here is maybe a 10% drop, and then you've got 90% drop all the way back down to here, right? So going from June till May, the closer to the money options have decayed, let's say 10% roughly. The thing is, when you start getting further out of the money over here through to, say, the 1800 strike, then if you now start here and then you say, okay, in the same amount of time, what's happened on a percentage basis? Well, now you've gone from here. This is 100% going from there to there is 100. Now look what's happened, right? You've now, within the same time frame, you've dropped, what is that, maybe 50, 60%? Okay? So you're getting 60% decay further out of the money, but then closer to the money, you're getting maybe 10%, right? So to me, this was really interesting. But I wanted more granular analysis, okay? So what I did was put together, where's the other guy? No, not that one. This guy. All right, so now what this spreadsheet here does is it's now comparing two expirations, right? It's comparing our June through to May, which is the same thing that we're doing. So again, we're going from 86 days through to 58 days, right? So basically a month. And then, you know, this thing is looking at both expirations in a similar kind of fashion through to what the other spreadsheet does. But the cool thing, I think anyway, is that then I kind of look at the comparison of the Greeks between those different expirations, right? And then if we look at the extrinsic percent differential, so what, let me kind of just touch on that, right? So, all right, so we're looking at the same thing that we were looking at on this graph here, because this thing here is basically the extrinsic, basically the amount of time value, right? So I'm looking at the amount of extrinsic here on this strike, and then I'm looking at the extrinsic here. I'm then figuring out the difference between them, and then I'm figuring out what the actual percentage decay is on a ratio basis. Just like I said before, this is roughly 10%, and this appears to be something like 60%. Okay, so I'm just doing that, but just in the spreadsheet. So so that's again what the extrinsic is, but then when I'm looking at the comparison, I'm then looking at this guy here, right? So I'm looking at the extrinsic percent differential between those two expirations for a particular strike. So if we look at this thing visually, this is what I found really interesting, right? Because this thing here is at the money, right there. These guys are in the money. And then as we go this way, this is out of the money, right? So to the right. And this, again, confirms the same thing that we saw visually before. So in other words, you can see that as we go further away from the money to the right, we can see that the extrinsic percent differential goes up. So in other words, per strike, we can see that between expirations, we're decaying at a faster and faster rate the further away from the money we get. Okay? But I thought this was really interesting. I didn't expect to see this, right? Which basically says that after you get to roughly 1650, the strike, all right, up to about here, notice that it basically flattens out. So it's actually overly simplistic to say that the further away from the money you get, the higher the rate of decay, because it actually breaks down after this point. So after this point, it flattens out and then actually starts going the other way around. Not that you'd want to go all the way out here, right? But I thought that was pretty...
Those puts are so cheap that they just can't decay that much.
Yeah, but on a percentage basis, you're talking about on a absolute value basis. I'm talking about on a percentage,
on a nominal basis, the price is is so small that.
Sure. Yeah, this thing here though. So basically, from looking at this, you may then say, well, okay, if we could basically sell something around here, then we're at the top of the curve. We're not too far away from the money, so therefore we can still grab a decent amount of credit, right? And then my objective is in trying to do this analysis was obviously trying to tweak the space trip trade and just selling credit spreads and that kind of stuff, trying to think about, all right, what's the so-called best location to sell at, right? And what was interesting then was that if we then look at the location at which is recommended, and again, I'm borrowing stuff from the parking trade, but I got a feeling that the guys didn't realize they hit it on the head, right, with the way that they came up with it, and that was that if you're doing a 25-point spread in SPX, they should be looking for a credit of $1, right? If you do that, And just to save you time, I won't kind of have, prove it, by the exact strike and so forth. But basically, you're right here, right? You're right at the top of extremely close to the top of this curve where you're getting, a huge amount of decay compared to going from month to month. And when you're selling a 25-point spread for $1 or a 50-point spread for $2, you're right in the sweet spot, right? Which to me kind of confirmed that that's the right location to sell, in my opinion.
Is that peak consistently about 20%, at the 20% below the current market, or 400 points, or does it vary a lot? Do you know?
Right. That's why I wanted to do this in a spreadsheet, right? Because I can come through here as an example, and I can change this from, say, go further out and say September, and then go June. Right, so now notice that there's a bigger gap here. It's not just a single month, right? But I am going further out, and then I can look at this and look at the new graph, right? So this tells me exactly what I want. So I can now do that comparison, and again, what you'll find is that when you're selling at those prices that I was suggesting, you'll be roughly about here, right? So very close to the very top of the maximum decay, and still getting a decent credit for it. So anyway, that's something I just wanted to share because I just created this last night, so I wanted to pass it on.
Sure, a quick question. Is the highest theta the price for the option? Did you see that question?
No, I didn't quite understand the question, but let me have a look. The highest theta price for the option.
Highest theta per price for the option. That's what you're measuring, right?
Well, no, we're measuring theta decay rate. So in other words, the ratio of the theta compared through to the extrinsic, right? So that's the first phase. And then the second thing that we're then doing is that we're then comparing how those numbers vary from expiration to expiration so that we can basically work out the decay rate between expirations, right? So, and, kind of just to kind of reinforce what Andrew was alluding to here, right? So if you're here and you're basically getting $1 credit, but you're basically, very close to the top of that decay curve, right? And you might say, well, I want to sell this guy, right? I'm gonna kill it, right? Because I've got the absolute maximum decay across this entire curve. Well, yeah, but you're at a strike of 1,000. So you're probably getting 20 cents if you're lucky for selling that, right? So, and then if you're spreading that, right, with a spread instead of just selling naked, then, you're making nothing. So that's the point. You really want to find the sweet spot in terms of collecting sufficient credit that makes it a reasonable gamble or bet, right? But knowing where you are on the decay curve across these expirations, right? So I wanted to make sure that I'm here, not here, right? But then again, if you think about the space trip concept, right, what we're doing really feeds into this, because what we're doing is that we're basically selling credit spreads up here in the decay curve, which decay fast, right? And then what are we doing with our debit spreads? Our debit spreads are around here, right? So the debit spreads decay slowly, which protect the credit spreads behind it, and the credit spreads decay fast, which gives us the credit more quickly, which is exactly what we want, right? So on an ideal perspective, you might say, well, why not put the debit spreads here? Because they'll hardly decay compared to the back, and that's correct, right? And that's one of the things that I'm looking to do now. I'm looking to create more of an income type of strategy, basically something similar to the road trip, but maybe even under, that you may put it on at roughly 60 days, which is pretty close. But I want to, take Dan's good work, right? But kind of see if I can tweak it in the sense of this realization here, right? Because with a butterfly, what you're doing is that the short strikes, so in other words, if you think of the wings, right, the left wing and the right wing, they're really pretty tight, right? So you're not necessarily taking much advantage of the decay curve, right? So if you were to split the wings up such that the debit spread is somewhere down here, but the credit spread is further away, so basically you have a condor instead of a broken wing, then at least from an options decay perspective, your in my opinion, getting better bang for buck because you're getting a little bit more juice out of options and how they work, right? Of course, everything else has to be put into balance, right? You want to have flat deltas and control your risk and not have too much margin, blah 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 blah, right? But again, my point is trying to leverage, data analysis of the options chains to see if I can extract useful information to then create trades around and optimize them.
I mean, you're trying to take advantage of option pricing to give the trade, some tailwind.
Yeah, a little bit of an edge. Yep.
Well, very cool, Ron. Really appreciate it. It's very interesting.
Yeah, no worries.
All right, so we're a little bit over our normal hour, but it was well worth it for the extra research that Ron's doing. Really appreciate it. Thanks, everyone who participated. It always makes the meetings more interesting when everybody can add their 2 cents. So thanks for everyone, and we will see you next week, and have good trading to everyone.
All right, thanks, Tom.
Thanks, Tom.
All right, bye.